So the market sold off, the charts tipped over, and instantly, almost as if by magic, a million internet traders transformed into extremely strict risk managers overnight. Welcome to This Explainer. Today, we're taking a calm, entirely flat look at the mechanics of market psychology. This is for people who like risk, but actually want to, live through it. We're simply observing the chaos from a quiet room.
Just last week, we were treated to a pretty stark contrast. On the left side of your screen, you've got the highs. These are the exact same accounts that spent the entire last month posting rocket emojis and aggressively celebrating their undeniable financial genius. And on the right, we have the immediate reaction to the drop. Those very same accounts are suddenly posting long, highly serious threads about position sizing and risk management. Notice that's threads, plural. It's a sudden and, quite frankly, fascinating transformation. And while half the market was busy panicking, a mega-IPO triced a valuation that literally does not fit on a standard desk calculator. A company that has never generated a single solitary dollar of profit was somehow valued at the GDP of a small nation. We have seen this exact movie before, playing out scene for scene. Think back to Pets.com in the dot-com bubble, or Rivian pricing into the stratosphere right before reality inevitably hit. Or how about Snowflake's massive debut, followed by all that sharp, sustained volatility? History repeats itself with zero modifications, and people lined up for this recent one anyway, because, well, they always do.
Part 1. The Illusion, Greed and Fear as a Package Deal.
Those Pets.com and Rivian buyers from the past, just like the IPO buyers we're seeing today, are simply people wanting upside. The sell-off panic we're watching right now, that's those exact same people actually meeting the downside. It is the same investors in the exact same week. You see, greed and fear in this specific context aren't opposites at all. They're actually the exact same appetite. We're just looking at it from two different sides of the table.
So it begs the question, can you want upside without inviting downside? No. You absolutely cannot want uncapped upside without inviting the downside to the party. The market does not sell upside without downside securely attached to it. It's a mandatory package deal, and it has always come as a set. Expecting one without the other is a mathematical and psychological impossibility.
Part 2. The Ultimate Personality Test. Who are you on the way down?
At the absolute top, we are treated to a textbook display of the Dunning-Kruger effect. When the market only goes up, novice retail investors fundamentally confuse a systemic bull run with their own undeniable financial genius. Everyone feels incredibly brave. Everyone confidently claims to have diamond hands. Cognitive bias totally tricks them into vastly overstating their actual risk tolerance, making them genuinely believe they're immune to panic. But bravery that hasn't been tested by real prolonged loss isn't bravery. It's really just a temporary chemical reaction to making easy money.
Everybody wants uncapped upside, until downside shows up wearing steel-toe boots. You really only find out who you actually are on the way down. You discover your true risk tolerance the exact moment the situation stops being a funny internet meme and starts being your real, rapidly vanishing money.
Part 3. The Emotional Damage Index, Grading Retail Sentiment.
This week, just looking at the cold data and the sheer, unadulterated volume of panic on the timeline, retail sentiment registers precisely at an 8 out of 10.
And an 8 puts the market firmly in the cooked category. This is a pretty noticeable step up from last week, where sentiment was merely mildly singed. However, we are still down from the all-time high of fully feral, which was famously recorded the day everyone on the internet simultaneously discovered leverage. The index just observes, folks. It does not judge.
Part 4. The Asymmetric Lesson, Predefining Your Downside.
Here's the trap. If you wait for a panic to figure out your risk limit, you have already lost. Identifying your true risk tolerance just cannot be done in a state of chaos. It has to be predetermined in absolute silence. You don't get to softly, comfortably choose your boundaries during a massive, aggressive sell-off. By then, it chooses you. The market is going to forcefully find your absolute breaking point for you in real time, usually in front of everyone, and almost always right at the absolute bottom. So here's how the unbothered actually do it. First, define the downside. Second, demand uncapped upside. Third, decide early. And fourth, hold calmly. The entire game is deciding exactly how much downside you can comfortably live with long before you actually need to know. You do this by aggressively stress testing your portfolio when the market is totally quiet. You set hard, unmoving mental stop losses before you ever even click buy. You make all these heavy decisions in advance, when nobody is watching, when the timeline is completely silent, and when your morning coffee is still warm.
Part 5. The mindset for winning. Temperament over strategy.
Look, valuations will wildly fluctuate. Paper money will change hands over and over again. Charts will tip over. But a calm, pre-decided mindset remains completely untouchable. Temperament is literally the only thing in this market that nobody can take from you, no matter how steep the drop gets.
Bet big, lose small, win forever. Now, keeping in mind that this explainer is obviously not financial advice, it's really just a calm, flat look at the reality of risk. But it does leave us with one final, vital question you need to ask yourself today. Are you genuinely building a temperament that can survive the inevitable drops? Or are you just holding on and hoping the downside never shows up wearing steel toe boots? Think about it. We'll leave it right there for this explainer.